Is there anything else from like an agency tax business structure setup point of view that I missed that you think people, that any frequently asked questions that you get that agencies, especially younger agencies, should be aware of?
Two that I think you missed are reasonable comp. You kind of sort of touched on it when you were talking about your structure. Reasonable comp is one, and then sales tax. And then I will tell you, like, we do a little bit of sales tax work, very, very sparingly. But the thing to know about sales tax is that it really, really depends on who you are, what you're doing, and where you're doing it. And, that gets, the only lesson I can give you there is it is super specific, and make sure that you're really researching that in the context of what you are doing.
So
right?
what would be an example of when, I think sales tax, I think like consumer purchases, right? You go to Target and there's a sales tax at Target right now.
Yeah.
What is the context of that for agencies?
Here's a great example for you. There's a large contingent of agencies in Texas. Texas taxes data processing. And you're like, well, whatever, I don't care. Data processing, I'm not doing data processing. Here's why you should care, is because Texas's definition of data processing captures just about everything that a digital agency does. Just about everything is probably a little bit hyperbolic. But a lot of what a digital agency does is captured under that data processing kind of definition. Now, I don't remember if it's North Carolina or South Carolina. They have, and I'm in South Carolina, but they've got a data processing piece in their sales tax code as well. Not the same thing. Texas is interesting because they've got a very specific private letter ruling that says that actually addresses an agency, and it's very, very clear. Whereas if you go to another state, data processing, it may or may not apply to an agency, who knows? But that's one of those things where sales tax has gotten more complicated, not less, over the last couple of years. It is going to get more complicated because states are going to need revenue. And so there's a lot of talk out there in the world about starting to tax services, which will most definitely capture marketers for sure. It may capture attorneys, and it may capture CPAs as well, which nobody's happy about.
Yeah.
But so if I had to distill that down, sales tax is one of those things to pay attention to going forward for sure. But then also make sure that you're looking at where you are and where you're doing business, and just have a really clear understanding of whether what you're doing is taxable or not.
And what was the other one that you said too, aside from sales tax?
A reasonable comp.
What's reasonable comp?
Great question. Okay. So let's say you have a corporation. That would be S Corp or C Corp. S Corp obviously is the most common type of structure that we see. So like you mentioned a little while ago, you're going to be an S Corp because you were trying to get away from payroll tax, right? So your incentive is to pay yourself as little as possible. Your incentive would be to pay yourself $1 out of that business, because then your payroll tax is only $1, and then you take the other $100,000 out and there's no payroll tax on it, right?
Yeah.
Okay. The IRS's incentive is exactly the opposite. So what the IRS says is you have to take something that is reasonable. Now, reasonable in IRS terms is not codified. That's another one of those situations, like, you've got to use some level of judgment, much like the employee versus contractor discussion. But you've got to come up with something that's reasonable. The way that you do that, and the way that we do that, is we can talk a study, and we'll say, all right, what is it that you do in the agency? What are your different functions? How good are you? So how proficient are you at those different things? And then we take that data and we have a software that layers that on top of Bureau of Labor Statistics data. So we're just using government data. And then we're coming up with a number like, okay, so you say you spend 2,000 hours, you spend it on these functions. This function, the market says that it's $45 an hour. And this function, so the market says it's $80 an hour. Smash them together, add them up. Here's your salary. It's whatever, 50 grand. So now you've got a document, you've got a study that says I should be getting paid 50 grand out of my agency. Everything that I make over and above that, I can take that out. It's not going to be subject to payroll tax. But, and this is really well baked into tax law with court cases and things like that. If you've gone through a process, you have a formula and you have a document that shows how you came up with this, everything's well documented, you're good, right? So if the IRS comes and says, we're going to characterize some of your salary or some of your distributions to salary, and you're going to pay us some extra payroll tax, you can say, no. I went through the study. I have this formula. This is how I came up with it. And they're going to say, okay, cool, you're good. Or they should anyway. Otherwise, the way that works when it doesn't go well is they will say, all right, $40,000 of this $100,000 that you took out in distributions, well, that's now salary to get you to a reasonable number. And here's a bill. And it's expensive and you're not going to like it, and it's going to be unanticipated, which is always the bad thing. So reasonable comp is a huge thing. Reasonable comp is also a thing on the C Corp side. So if you got a corporation, you need to be paying yourself reasonable compensation. If you need to pay yourself reasonable compensation, you need to have a process to do it.
Yeah, I definitely fall into that category, because when my previous accountant had set it up, I don't think he knew what my total income was. And he basically was like, yeah, you just, take a minimal paycheck and then you should be good.
The rule of thumb process is very well baked in the tax law that doesn't survive.
Is there like a percentage rule of thumb of like let's say you make, I don't know, $500,000, right? In total, all the money that's going to flow into your personal account, how much of a percentage of payroll like standard payroll do you take off that?
Yeah, it doesn't work. That would never survive tax court.
I might be screwed, man.
Well, I mean, it's one of those things that it's okay until it's not.
I think this year, I had a very large jump in income last year, and I think that would potentially like put me in a culpable situation,
Yeah, but it's also possible that you have a business and you spend hardly any time in it and it makes a whole bunch of money, and so your reasonable comp is kind of low. That's possible too. It's also entirely possible that you spend a whole bunch of time, it doesn't make any money, and your reasonable comp is really high, and that's not a good situation either. So that's one of those things where you have to be making sure that you're taking all of your facts and circumstances into account. You're working with a trusted advisor. You're thinking through this, right? It's not one of those things where you can just kind of stick your finger up in the air, see which way the wind is blowing, throw a percentage at it, and just call it good. You can, but it's like I said, it's good until it's not.